Nothing like a Saturday night reconciling my cash account.
This video covers bank reconciliations, or as they're more commonly referred to as bank recs. Some points to note here: bank reconciliations are not financial statements. They compare the bank statement balance to the cash account balance on a company's trial balance, or the cash account on the books. And because it's the cash account on the books, we refer to the cash balance as the book balance when we're doing bank recs. And what we do is we have the bank statement balance, we have the cash account balance, and we look for all of the adjustments that are needed so that we can come up to that same amount. We adjust for differences to get to what we call the true or adjusted cash balance. Most of our differences are going to be timing differences, but the benefits of doing a bank reconciliation is it helps identify any errors that could have been made either by the company or the accountant who's recording in the books or by the bank. And it helps identify any missing or unusual items. So let's start with our bank reconciliation schedule, what it's going to be like. So this is going to be as of one point in time, specific date. This is the financial statement date, such as the fiscal year end. And on one side, we're going to start with our bank statement balance. Split this down the middle. Yes, that is a straight line. And on the other side, we're going to have the cash or the book balance. We're going to make some adjustments. Let me make my whole schedule here. I need to remember everything that's on this schedule. I'm going to put in 1, 2, 3, 4, 5, 6 more lines. Straight lines. Only this had been done in Microsoft Word, I could have just nice and easily inserted a table. That wouldn't be as fun. All right, so let's start with the bank statement. So how do we find our bank statement balance? We either get that printout mailed to us, or we go online and we look at the balance at that one point in time, the end of the accounting period. And then we're going to make some adjustments here. The bank statement adjustments that we have here, these are things that the company recorded, but the bank did not. So let's see, we are going to start by adding deposits in transit. So you're probably wondering, what is a deposit in transit? So below our schedule, let's come down and let's write out the definition for deposits in transit. This refers to checks that the company received. So customers wrote the company checks, they received them, and they recorded it. What do we do when we get a check? We immediately record it in our checkbook, and companies are going to record that journal entry to say debit cash, increase the cash account. Recorded it in its books, but hasn't been deposited or hasn't cleared the bank. So maybe it's recorded and then the checks are just waiting to go to the bank, or maybe they were deposited and it takes a day or two for that check to clear, for the funds to come out of the customer's account and into the company's bank account. So it could be in that period. Okay, so because they were already adjusted on the books, but they weren't included on the bank statement balance, this is stuff that the company recorded, but bank didn't. Not yet, just a timing difference. We are going to add these deposits back. Give it a couple days and it will be in there. We know that it's owned by the company, so it should be added there. Okay, and then on the other hand, we need to subtract out outstanding checks. Okay, so let's go down and define our outstanding checks. These are checks that the company wrote, so payments made and recorded by the company. When you write out a check, even if it's online, what do? You immediately take out your checkbook and make sure that you've recorded it. So the companies are going to do the same thing. Every time it makes a payment, it's going to immediately record that journal entry into the accounting system. But it hasn't cleared the bank. But not yet processed by the bank. And it could be that it's just going to take a day or two after that year end or that end of the accounting period. So we need to subtract them out of the bank balance because very soon that's what's going to happen. It's going to leave that bank. I'm going to skip 2 lines because really there's nothing else here. We need to adjust for any errors that the bank may have made. And we can't say whether to add or subtract. It depends what the error was. And then finally we get to the adjusted, or sometimes we call it the true cash balance. But we don't stop here. We also make the reconciliation from the company's book or cash account in the ledger. Start with the book balance, and then we're going to add collections that were made by the bank on behalf of the company. So sometimes you'll have a company that says, for the customers, rather than sending in payment to the company, the customer is told to send the payment directly to the bank. So the bank gets it. The company doesn't know about it until the bank informs them, because they look at the bank statement and they say, oh, some collections were made. We need to record that as a journal entry. And so after we do this reconciliation, we're going to come back and also see what items here require a journal entry. So this is going to be one of them. It's going to require a journal entry. We'll get to that later. We're also going to add any interest that might have been earned on this company's bank account, this bank savings. And we're going to need a journal entry to record that so that we can update our cash balance. We're going to need to subtract. Look at that bank statement and we see some of our customers didn't have enough money. They wrote us a check, but the check bounced. And we call that the non-sufficient funds check. We only know about it when we got the check. We recorded in our books that we received the cash, we reduced the receivable. But as it turns out, we find out on our bank statement that it didn't clear. We call these NSF checks. Okay, let's add a little definition here down below. What are NSF checks? Checks the company received and recorded. But they did not deposit. Or they did not clear. Then we would just say normal English, those checks bounced. This is because the customer who wrote the check did not have enough in their account. Or in a fancy way to say it, they lacked the funds. So the company is notified, they make a journal entry for it, and then of course the next thing that they do is they call that customer and say, you owe us, plus you owe us whatever the penalty is, $20, $30 as a fee, because we are going to have to pay the bank for this bounced check. One more thing to subtract. Subtract any bank service charges. We are notified of them when we look at that bank statement. If there were any errors made, we're going to adjust for errors on our part. And then finally, we get to that adjusted or true cash balance. And these will always be the same. If not, then something was wrong. These will always equal. Okay, and then so finally, journal entries are recorded for any adjustments. To get from the book balance or the cash balance to that true cash balance to update the company's cash account.